Hi, how are you? This is Carson Taylor from DVM Success. Today, I want to talk to you a little about private equity and what private equity investors seek in veterinary services. Part one will be an overview of private equity. Part two will focus more on the second question, why they like veterinary services. So let's begin. First, a little background on what is a private equity fund. But taking even another step back, I want to talk about private equity generally. So private equity mandate is to buy majority ownership interests in cash flow positive private companies and hold these investments for 3 to 5 years. So there is a requirement that the companies produce cash. This allows for the use of debt. There is the desire to own a majority stake or control the company, and there's a time frame, a time limit, 3 to 5 years. Let's call that medium term. If you want to define private equity, the best definition I could come up with is that it's an asset class similar to an asset class such as bonds, stocks, venture capital, all of which have various characteristics from the perspective of an investor. The characteristics I think that are important to note for private equity are these investments are illiquid. In other words, you can't trade in and out of them once you commit money to a fund. You seek control. Once you invest in a private equity fund, you, through your proxy, the private equity firm, will have control over those investments. And as I said before, there's a medium-term time frame, 3 to 5 years. So a little background on a private equity fund. There are basically two key parties to a fund. There's the manager, private equity firm, which we call the general partner. And then there are the limited partners, the individuals or institutions who put up the money that is invested through the private equity firm. The general partners on the left there, you can see their role is to determine which investments to make and to manage those investments. They contribute to the fund their time and expertise, and sometimes a little bit of money to align incentives. In exchange, they earn various fees for that, one of which is a management fee, which you can think of as kind of a recurring fee they get depending on the size of the fund. And secondly, they earn a share of any returns the company gets when they're able to sell it. On the other hand, you have the limited partners. They're passive investors to the fund, and they contribute money. And they earn returns when the investments are sold, net of any management fees. So that's the basics behind a private equity fund. Two parties, general partner and limited partner. Let's talk a little more about who the limited partners are in these funds. Typically, you have two types. You have individuals. These are high net worth families, can typically write $1 million plus checks to invest in a private equity fund. Or you have what I like to call pooling institutions. Institutions who gather up the savings of many individuals and professionally invest those savings. A couple examples can kind of put this into perspective. Example one would be sovereign wealth funds. Norway has a sovereign wealth fund that has assets of $1 trillion, about 200,000 per citizen. Nice to live in Norway. So they'll look at the $1 trillion they have. They'll make various investments across the world in all varieties of asset class, and they will have an allocation within that fund to invest in private equity. Similarly, pension programs. These are programs that are collecting pensions from employers and representing beneficiaries. One good example is the Canadian Pension Plan Investment Board. This board has $350 billion in assets, and it's growing, and it represents a defined benefit pension of 20 million Canadians. Similar to a sovereign wealth fund, within that $350 billion, they'll have an allocation, a carve-out, which they will invest in private equity over time. They'll determine what that carve-out is based on the market conditions, based on their mandate, based on a whole bunch of factors that I can't observe or detect, but they will allocate a certain amount of that fund to invest in private equity. Finally, you have diversified asset managers, someone like BlackRock. BlackRock has $6 trillion under management from who knows how many individuals and companies. they will have a piece of that 6 trillion that they invest exclusively in private equity. So what's their objective? Well, they're looking to find general partners who can invest in companies to earn a return on their equity that is higher per unit of risk than what an investment in the stock market would bear. Let me dig into that a little. If you think about being an investor, you have an opportunity to invest all across the world in all variety of asset classes. You can buy government bonds, you can buy corporate bonds, you can buy public stocks in the US, public stocks in any other country. Primarily what you're seeking is to maximize the rate of return on your investments while minimizing risk. Private equity, because of the fact that you're buying effectively stakes in companies, has a different risk and return profile than other kinds of investments. And so you're making these investments because you hope that you can earn more with less risk than an alternative, which generally would be, say, a public equity. Private equity, however, is illiquid. So the return objective for these funds typically is higher than what you might expect from just putting your money into an index fund or investing in public equities. Typically, the return these investors seek is an annual return of at least 15% after fees. And when we would model out private equity models at my previous job, we would always try to solve to about a 15 to 20% type return, as that's what the limited partners are seeking through these investments. So let's talk a little about the general partners. These are the private equity professionals. They come from a variety of backgrounds. Some of them run companies, some of them had run companies, some of them worked on Wall Street as I had, a variety of different backgrounds. But there are basically two types as I see it. There are investment management firms, which have a part that invests in private equity. And then there are pure play managers, which do only private equity as the general partner in both cases. So the objectives of the private equity firm, the general partner, are slightly different. For one, there's a capital raising objective. In other words, if I'm a private equity firm, the way I stay in business is continuing to raise private equity funds. A given manager might have several funds and invest over time out of many different funds. That's how you kind of stay in the game as a private equity manager. You continue to raise funds, continue to invest them, continue to sell the companies, continue to harvest your returns. The other thing that the general partner is focused on with the fund is the investment selection. They have to figure out what companies are suitable, screen those investments, conduct diligence, and buy those companies in the way that makes the most sense for their investors. And then once they buy the companies, they have to manage them. They monitor the performance and look at ways to drive growth in conjunction with the management of the companies. Generally, they do this through board representation. Finally, they focus on the capital market aspects, which is one, they manage the debt structure of the investments, and two, they seek to exit the investments. They get paid when they exit, when the fund closes down, through their performance fees. The economics on the bottom of the page, as I talked about, there is a management fee, so an ongoing annual or quarterly fee that's assessed as a percent of the money that they're investing, usually 2%. And usually these fees are there to kind of keep the lights on. Where they really make their money are through performance fees. When they successfully harvest a fund by selling the companies that they've bought, they will be given a percent of the investment profit, typically 20%. So if they invest $500 million in one company and it sells for $1 billion, they'll earn 20% of that $500 million, $100 million bucks. Pretty good amount of money. Now, private equity firms are pretty diverse, and they pursue a wide variety of strategies, and they invest in a wide variety of companies. I wanted to go through a couple common private equity strategies, though, to get a sense, to give you a sense of how they make their money over time. So, two strategies that are almost always used on every investment made by private equity is leverage buyout, which is effectively you're using debt when you buy the company so that you can magnify the returns to the equity contributed from the limited partners. And over time, you carefully manage this debt. Markets get better, you refinance at a better rate. If you're able to, you can put leverage on the company to pay yourself and your LPs a dividend. Many different ways to manage the debt stack, and private equity companies will be very focused on this. Secondly, there's an operational focus. As a private equity firm, you're going to seek to implement sort of best practices operationally that you'll be able to pull from your experience or from the executives that you know. Typically, these are going to be employed on any private equity investment that's made. Now, there are a number of other strategies that kind of are specific to an industry situation or specific to a company situation. One of these that is prominent in my mind is a platform buy and build. What you need here is an industry that's comprised of mostly small companies. So in this strategy, you buy a company that's well run that you can work with the management team with. And then over time, over the investment horizon, you buy a number of other small companies, roll up the business into a larger entity. This should ring some bells because this is a strategy used in veterinary services. Another company or industry specific strategy might be a turnaround where you're buying an underperforming company, but the industry is okay. You swap out management and make some operational improvements. A second might be a consolidation strategy where you're in an industry where there are a lot of large companies. It's already consolidated. You buy one company and then you buy a second big one and realize operational synergies. Fourthly, a carve out. Here you're buying a business sold from a larger company and you're standing it up for growth outside the parent. What all these strategies have in common and what the strategy objective is generally is to drive growth. If private equity firms can grow revenue and profit on the investments that they make, they'll make a good investment. So all of these are ways to take a company and to grow it. And that's really how private equity funds make their money, through these different strategies.